It has been a wild week on Wall Street. Markets coming off of a big rally after a busy day on the economic calendar. But the week started after a huge sell-off last Friday. It comes, of course, ahead of the Federal Reserve meeting next week. My next guest says the Fed does not want to shock the market. Joining us right now is the global head of managed investments at Citi's private bank, David Bailin, joining us right now. And David, it's good to see you.
A pleasure.
Thanks so much for joining us. So the Fed meets next week, the 21st. I think everybody agrees now we're not going to see an interest rate increase. Is that where you sit?
That's where we sit. Yeah. About a 20% likelihood if you look at how the market is measuring it. All of the data came in, and it's fairly weak, not confirmatory for a rate rise. Unemployment numbers, inflation numbers, pretty much economic activity numbers, and then and you saw yesterday just that the market sort of now finally believe that it's probably unlikely to occur.
But do you think we're going to see a hike in December? I mean, are you expecting an increase this year or no? Yeah,
I mean the bank is expecting an increase, and every time we say that, and we've said that over and over again, it really is dependent upon a set of consistent data that shows over a period of several months that the growth rates are sustainable, that these factors we talk about are actually going to increase to indicate real robust economic growth. And every time we have this conversation, almost for the last 12 months, as we get to the meeting, we just see that the data is simply not there.
We're getting really terrible data though that's giving mixed messages to the Fed, right? We haven't hit their inflation target. We've met it on the jobs, but they've been focused on the globe, currencies. One of the big things that came out that's a leading economic indicator is a non-manufacturing PMI, lowest in 6 years. That's the bulk of our economy right there. Services about 60 to 70%. One of the issues that we've noticed with the Fed is that they look at the market. I think one of the biggest data points is where's the market this year, where's volatility. If we have a spike in volatility, which we have now, I don't think there's going to be a market move. But come December, should it be low, will they raise rates? And then what will their guidance be? Because that's what set up volatility last year, that they were going to raise 4 times this year, and they didn't. So do you think guidance going forward will be one and done?
No, I don't think the Fed has ever been in a sort of guidance as one and done mode. They actually want to get into a consistent pattern. If they begin to raise rates, to do so over time. This would give them much more ammunition in the event that the economy stalled in the future. So there's no history that suggests that they want to do it once and then stop. And I think you're exactly right that you're going to have to see other data, and they do look overseas. They really are very concerned about markets. I think one of the reasons they won't go is because of market volatility and because the messages that were given out, Bank of Japan and ECB, all indicated that people are having doubts about their continued commitment to low rates, which we think is absolute. So there's a lot of reasons why they aren't going to go now, but if they are going to go, they're going to try to go continuously. They've already been through the one and done in December, and that was a bad action.
David, I take your point about how we probably shouldn't expect a rate rise this month, but shouldn't there be a rate rise when you look at how these central bank experiments around the world have failed to give the growth they anticipated? They keep overestimating the impact here. They are now punishing savers with historically expensive government bonds. First negative rates in 5,000 years of recorded history. This is really a tax on savers, isn't it? And isn't it time for the Fed to stop punishing savers?
This is really not sort of the Fed punishing savers as policy. That's not their intent.
That's not their goal.
That's not their goal. In terms of the impact.
And the impact here has not nearly been as devastating. I mean, 38% of the world's bonds have negative rates. We don't have them here.
That's true.
Savers here are still being paid. Our level of economic activity at 2.5% is materially greater than all the developed markets save China. So you can't really look at this market and say, they're punishing savers as policy. That's just not.
It's not a policy, but unfortunately, that's what they're doing.